Hello everyone and welcome back to this channel, and today I'm going to walk you through the comparison between mutual funds and fixed deposits. Which should you invest in using Cowrywise? Now, the first thing you need to know is that this is an article published by Cowrywise, and it's about the differences between the mutual funds and the FD and compares them so that you can choose the right investment option that works for you. First of all, what is fixed deposit or FD? These are financial products where you deposit a certain amount in the bank which can be withdrawn after a certain period of time. The interest rates offered on fixed deposits is higher than that of savings account and recurring deposits. You can invest in fixed deposits for a period ranging from 30 days to 360 days and even invest a minimum amount of 100,000 naira. You can also open a fixed deposit bank account through banks or any financial institution such as mutual funds or stockbrokers. Now, what is mutual funds? Mutual funds (MF) are a type of investment that has the goal of generating returns for the investor who pays fees to the fund manager for managing the portfolio. So mutual fund comprises a collection of different stocks and bonds, and each share in a mutual fund represents an ownership stock in all those underlying assets. So the fund manager runs the portfolio by deciding which securities they will buy or sell based on their perception of market conditions at any given time. They can also change the strategies over time to take advantage of changing market conditions or trends. Now here comes the big question. Should you go for mutual funds or fixed deposits? Well, since we know that mutual funds are funds that are managed by a professional fund manager, a mutual fund is also a collection of money from many investors who pool their money to invest in stocks, bonds, and or other assets. While fixed deposits, on the other hand, are funds deposited in a bank for a fixed period of time. An investor can earn greater returns on his money by investing in mutual funds as compared to fixed deposits because they offer higher interest rate than fixed deposit does. You see, equity mutual funds have higher risks and are better suited for investors with a high risk appetite as compared to debt mutual funds, which have a lower risk but may not generate as much return on investment. As an investor's risk profile changes over time, it is advisable that they switch between equity and debt-based investment strategies to get the best returns without jeopardizing your capital base too much. So, as an investor, it is advisable that you switch between these two.